Are Trump's new tariffs, hitting on August 7th, 2025, about to shake up your stock portfolio? With rates as high as 41% targeting global imports, markets are already reeling, $2.4 trillion wiped out in a single day. In this video, we'll break down how these tariffs will hit technology, retail, and industrial stocks, and share 5 actionable strategies to protect your investments. Let's start. President Donald Trump's tariff plan, effective August 7, 2025, is one of the biggest trade shakeups in decades. These reciprocal tariff slap rates from 10% to 41% on imports from nearly every country trading with the US. For example, Canada faces a 35% tariff, Switzerland gets hit with 39%, and countries like Syria and Laos are looking at a steep 41%. The goal? Protect American jobs and boost US manufacturing by making imported goods more expensive. But here's the catch. These tariffs cover everything from cars and auto parts to electronics, clothing, and metals like copper, which faces a whopping 50% duty. Some items, like certain semiconductors and pharmaceuticals, are exempt, especially for companies investing in US production, like Apple's $100 billion commitment to American manufacturing. Still, these tariffs act like a tax on US consumers and businesses, and the stock market is already feeling the heat. Why should US investors care? Because these tariffs could reshape your portfolio, from tech giants to retail chains. Let's dive into the sectors most at risk and where you can find opportunities. The tech sector is a cornerstone of many US portfolios, but it's in the crosshairs of these tariffs. Companies like Apple, Nvidia, and Dell rely on global supply chains, especially from countries like Taiwan, which faces a 20% tariff on electronics, though semiconductors are exempt. Higher costs for components could force these companies to raise prices, potentially cooling consumer demand for gadgets like iPhones or laptops. For example, Apple's supply chain includes parts from Taiwan and other high-tariff countries. While Apple's $100 billion investment in US manufacturing might soften the blow, higher production costs could still squeeze margins. The Nasdaq, heavily weighted with tech stocks, already dropped 6% in early April 2025 when tariff details leaked. But it's not all doom and gloom. Domestic semiconductor companies like Intel or Texas Instruments could benefit from tariff exemptions and increased US manufacturing incentives. If you're holding tech stocks, keep an eye on companies shifting production to the US. They could be winners in this trade war. Next up, retail, a sector that's getting hammered. Retailers like Nike, Walmart, and Mattel import goods from countries like India, 25% tariff, and Taiwan, 20% tariff. Nike has already warned of $1 billion in additional costs, which could mean higher prices for sneakers, apparel, and other consumer goods. Analysts estimate price hikes of 2 to 15% across retail products, from clothing to toys to electronics. For US investors, this is a double whammy. Higher prices could reduce consumer spending, hitting retailers' sales and profit margins. Walmart, for instance, relies heavily on imported goods, and its stock could face pressure as costs rise. Smaller retailers without the scale to absorb these costs might struggle even more. If you're invested in retail, now's the time to reassess your exposure. Industrial stocks like Ford, General Motors, and Caterpillar are also feeling the heat. Tariffs on cars, 25%, and metals like copper, 50%, will drive up production costs. For example, Ford and GM import auto parts from Canada, 35% tariff, which could lead to higher car prices and lower demand. Caterpillar, which uses imported metals, could face supply chain disruptions and border delays due to stricter customs checks. Japan's Nikkei 225 crashed 7.8% after the car tariff announcement, showing how global markets are reacting. For US investors, industrial stocks with heavy international exposure are risky right now. However, companies with strong US-based operations, like Deere & Company, might gain a competitive edge as imports become pricier. These tariffs are sparking serious market volatility. In April 2025, the S&P 500 lost $2.4 trillion in a single day, and the CBOE Volatility Index hit its highest level since August 2024. US investors are understandably nervous, and many are turning to safe haven assets to weather the storm. Gold is a standout, rallying 1.85% as investors seek protection from tariff-driven uncertainty. Gold ETFs like SPDR Gold Shares and iShares Gold Trust are seeing strong inflows. Other safe havens, like U.S. treasuries and currencies such as the Japanese yen and Swiss franc, are also gaining traction. Interestingly, the U.S. dollar has weakened to a 6-month low against the yen and franc as global investors worry about America's economic outlook under these tariffs. For U.S. investors, safe haven assets can act as a buffer against stock market swings. We'll talk more about how to use them in our portfolio strategies later. Beyond the stock market, Trump's tariffs will hit the broader U.S. economy and your wallet. The Penn-Wharton budget model predicts a 6 to 8% drop in U.S. GDP and a 5 to 7% decline in wages over time. Middle-income households could lose $22,000 to $58,000 in lifetime income. Yale Budget Lab estimates consumer prices will rise 2% in 2025 alone, costing the average household $2,700. For U.S. investors, this means less disposable income for consumers, which could hurt companies tied to consumer spending like retail and tech. Goldman Sachs now puts the risk of a U.S. recession at 45%, up significantly since the tariff announcement. Globally, the IMF and OECD have cut growth forecasts, warning of supply chain disruptions and higher inflation. These tariffs act like a tax on American consumers, making everyday goods more expensive. For investors, this economic backdrop means you need to be strategic to protect your portfolio. Now, let's get to the good stuff: how U.S. investors can protect and position their portfolios for Trump's 2025 tariffs. Here are 5 actionable strategies to navigate this trade war. Boost safe haven assets. Allocate 5 to 10% of your portfolio to gold ETFs like SPDR Gold Shares or iShares Gold Trust. Gold's 1.85% rally shows it's a reliable hedge against volatility. U.S. Treasury ETFs like iShares 20-plus year Treasury Bond and yen-based ETFs can also add stability. Invest in U.S.-focused companies. Shift toward companies with minimal reliance on imports. Look at domestic manufacturers like Intel or Texas Instruments in tech, or Deere & Company in industrials. These firms could benefit from tariff exemptions and a stronger U.S. manufacturing push. Diversify internationally carefully. Not all countries face sky-high tariffs. Australia, 10%, and Japan, 15%, have lower rates due to trade deals. Consider ETFs like iShares MSCI Australia or Japan-focused funds to diversify without heavy tariff exposure. Rethink retail and consumer stocks. Retailers like Nike and Walmart are at risk from higher costs and weaker consumer spending. Consider trimming exposure or using options to hedge downside risk. Look for defensive consumer staples like Procter & Gamble, which rely less on imports. Stay liquid for opportunities. Keep 10 to 15% of your portfolio in cash to take advantage of market dips. Volatility is here to stay, and Trump's history of reversing tariffs could spark quick rallies. Stay nimble and monitor trade negotiations closely. Trump's 2025 tariffs are a game-changer for U.S. investors, hitting tech, retail, and industrial stocks while driving volatility. But with the right strategies, safe haven assets like gold, U.S.-focused companies, and smart diversification, you can protect your portfolio and even find opportunities. Stay informed, stay flexible, and don't let these tariffs catch you off guard. Thanks for watching, and we will see you in the next video.